I've studied every major real estate crash in modern history. The crash of the early 1990s, the savings and loan crisis, the 2008 financial crisis that nearly destroyed the global economy, the commercial real estate downturn of the early 2000s, and I've studied smaller regional crashes in markets like Tokyo in the 1990s, Spain and Ireland in 2008, and various Chinese cities over the past decade. And across all of these crashes, across all of these different markets and time periods, there are patterns, there are warning signs that always appear before real estate crashes. Always. If you understand these patterns, if you can recognize these warning signs, you can protect yourself. You can get out before the crash. You can avoid devastating losses. Or if you're sophisticated, you can position yourself to profit from the crash by shorting real estate or by having capital ready to buy assets at distressed prices. That's what I do. I look for these patterns, I watch for these warning signs, and when I see them accumulating, I know a crash is coming. I know it's time to get defensive or get aggressive, depending on my positioning. Right now, in late 2025, I'm seeing these warning signs everywhere. Not in all real estate markets, not in all property types, but in enough places, in enough sectors that I know we're heading toward a significant real estate downturn, maybe not as severe as 2008, but severe enough to create massive losses for people who aren't prepared, severe enough to create massive opportunities for people who are prepared. So I'm going to walk you through exactly what always happens before real estate crashes, the patterns you need to watch for, the warning signs you need to recognize, and what you should do about it. The first thing that always happens before real estate crashes is excessive credit growth. Real estate crashes don't happen because property fundamentals suddenly deteriorate. They happen because too much debt has been accumulated, because lending standards have been relaxed, because borrowers have taken on more debt than they can service, because lenders have made loans they shouldn't have made. Real estate crashes are always, always, always preceded by credit booms, by periods where debt grows much faster than incomes or rents or property values should support. Let me explain the mechanism. Real estate is a leveraged asset class. Most properties are bought with debt. Residential mortgages, commercial mortgages, construction loans. This leverage amplifies returns on the way up. If you buy a property for $1 million with $200,000 down and $800,000 borrowed, and the property appreciates to $1.2 million, you've made $200,000 on a $200,000 investment. That's a 100% return. The leverage magnified your gain. But leverage also amplifies losses on the way down. If that same property declines from 1 million to 800,000, you've lost your entire 200,000 equity. You're wiped out. And if you can't make the mortgage payments, you default. The lender forecloses, you lose everything. This is how real estate crashes happen. Leverage turns normal price declines into catastrophic losses. So the warning sign to watch for is excessive credit growth. When mortgage debt is growing much faster than incomes, that's a warning sign. When commercial real estate loans are growing much faster than rents, that's a warning sign. When loan-to-value ratios are increasing, when lenders are requiring less equity down, when underwriting standards are loosening, these are all warning signs that too much leverage is building in the system. Before the 2008 crash, we saw all of these warning signs. Mortgage debt in the United States grew from about $5 trillion in 2000 to over $10 trillion in 2007. It doubled in 7 years. Incomes didn't double, rents didn't double, but debt doubled. That's unsustainable. That's a sign that a crash is coming. We also saw underwriting standards collapse. In the early 2000s, you could get a mortgage with no money down, no income verification, no job verification. These were called ninja loans. No income, no job, no problem. You could get a mortgage. Lenders were giving mortgages to anyone with a pulse. They didn't care if borrowers could actually afford the payments. They didn't care if the loans were going to default because they weren't holding the loans. They were securitizing them and selling them to investors. So they had no skin in the game. They just wanted to originate as many loans as possible to generate fees. This is what always happens before real estate crashes. Underwriting standards deteriorate. Lenders get greedy. They start making loans they shouldn't make. They convince themselves that prices will keep going up forever, that borrowers will be able to refinance, that defaults won't happen. and then prices stop going up, borrowers can't refinance, defaults spike, and the whole system collapses. Right now, I'm watching credit growth carefully. In residential real estate, mortgage debt growth has been modest. Underwriting standards are still relatively tight compared to the mid-2000s, so I'm not seeing the same warning signs in residential that I saw before 2008. But in commercial real estate, I'm seeing very concerning signs. Commercial real estate debt grew significantly from 2015 to 2022. Office buildings, retail centers, apartment buildings, all financed with cheap debt when interest rates were near zero, and now interest rates are much higher. Many of these loans were floating rate loans tied to LIBOR or SOFR. When rates were at 1 or 2%, the debt service was manageable. Now rates are at 5 or 6%. The debt service has tripled. Many properties can't cover their debt service from rental income anymore. The loans are underwater. The properties are worth less than the mortgage balance. This is setting up for a wave of defaults and foreclosures. This is the excessive credit growth warning sign flashing red. The second thing that always happens before real estate crashes is speculative excess. This is when people start buying real estate not to use it or to generate rental income, but purely to speculate on price appreciation. They're buying because they think prices will go up. They plan to flip the property. They plan to sell to someone else at a higher price. They're not investors. They're speculators. And when speculation becomes widespread, when everyone is speculating, that's a sign that a crash is imminent. You can measure speculation in several ways. One way is to look at the percentage of purchases that are for investment rather than owner occupancy. In a healthy housing market, most purchases are owner occupied. People are buying homes to live in. But when speculation takes over, you see the investment percentage spike. In 2005 and 2006, before the crash, investment purchases reached 20 to 25% of all home sales in some markets. That was crazy. That was pure speculation. And it was a clear warning sign. Another way to measure speculation is to look at flipping activity. How many properties are being bought and sold within a short period, 6 months or a year? Flippers are pure speculators. They're buying properties, maybe doing some cosmetic improvements, and trying to sell for a quick profit. When flipping activity spikes, when you see HGTV shows glorifying house flipping, when your neighbor or your hairdresser is talking about flipping houses, that's a warning sign. That's speculation reaching a fever pitch. That's a sign that the end is near. Before the 2008 crash, flipping was rampant. People were buying condos in Florida and Las Vegas and Phoenix with the explicit intention of flipping them before construction was even complete. They weren't even going to take possession. They were just going to assign the contract to another buyer at a higher price. This is pure, unadulterated speculation, and it ended in disaster. When prices stopped going up, when the greater fools stopped showing up, flippers couldn't sell. They were stuck with properties they couldn't afford and didn't want. They defaulted. Prices crashed. I'm also watching for speculation in commercial real estate. This shows up differently than in residential. In commercial, speculation shows up as aggressive underwriting assumptions. Developers assuming they can raise rents by 10% per year. Investors buying properties at 3 or 4% cap rates, assuming they can sell at even lower cap rates in the future. Private equity firms raising massive real estate funds and deploying capital at peak valuations because they have to put the money to work. Right now, I'm seeing some speculative excess in certain commercial real estate sectors. Multifamily was very speculative. From 2020 to 2022, developers built aggressively, investors paid high prices. Everyone assumed rents would keep rising forever. Now, supply is overwhelming demand in many markets. Rents are falling, properties are worth less than investors paid. That speculation is unwinding. That crash is happening right now in real estate markets like Austin and Phoenix and Nashville. The third thing that always happens before real estate crashes is affordability deterioration. This is simple math. When prices rise faster than incomes, properties become less affordable. Fewer people can afford to buy, demand weakens, and eventually prices stop rising, then they fall. Affordability always deteriorates before crashes because the price appreciation itself destroys affordability. You can measure affordability in several ways. The most common is the price-to-income ratio. How many years of income does it take to buy a median-priced home? In a healthy market, this ratio is around 3 to 4. A median home costs 3 to 4 times median household income. But in bubble markets, this ratio expands to 6, 7, 8, or more. In San Francisco and San Jose, it reached 10 or more before the dot-com crash. That's insane. That means a household earning $100,000 is trying to buy a $1 million home. The math doesn't work. Another way to measure affordability is the mortgage payment to income ratio. What percentage of median income is required to make the mortgage payment on a median-priced home? In a healthy market, this is around 25 to 30%, but in bubble markets, it expands to 40, 50, even 60%. At that point, buyers are house poor. They're spending more than half their income on housing. They have nothing left for other expenses. They're stretched to the breaking point. And if anything goes wrong, if they lose their job, if rates rise, if property taxes increase, they can't afford the payments. They default. Before the 2008 crash, affordability deteriorated dramatically. From 2000 to 2006, median home prices roughly doubled in the United States. But median incomes were basically flat. So the price-to-income ratio doubled from around 4 to around 8. At the peak, in markets like California, Florida, and Arizona, median homes cost 7 to 9 times median income. That was unsustainable. That was a clear warning sign that prices had risen too far, too fast, that a correction was inevitable. And it's not just about whether people can technically qualify for a mortgage. It's about whether people can actually afford the total cost of homeownership. Mortgage payment, property taxes, insurance, maintenance, utilities. When these costs consume 50 or 60% of income, people are stretched, they're vulnerable, they're one emergency away from financial crisis. And when enough people are stretched, when enough people are vulnerable, defaults start to rise, and defaults lead to foreclosures, and foreclosures lead to distressed sales, and distressed sales push prices down, and falling prices lead to more defaults. It's a vicious cycle. Right now, affordability is terrible in many U.S. housing markets. Prices rose dramatically from 2020 to 2022 during the COVID housing boom. Interest rates were at historic lows. People could afford big mortgages. They bid up prices, but now rates are much higher. A mortgage that cost $3,000 per month at 3% rates now costs $5,000 per month at 7% rates. Affordability has been destroyed. The median home in the United States costs about 6 times median income. In expensive markets like California and the Northeast, it's 8 to 10 times. This is unsustainable. The saving grace right now is that most homeowners have fixed-rate mortgages at low rates. They locked in 3% mortgages in 2020 and 2021, so they're not feeling the payment shock. But new buyers are, and that's why home sales have plummeted. Existing home sales are at the lowest levels in over a decade. People can't afford to buy at current prices with current mortgage rates. Demand has collapsed, and when demand collapses, prices eventually follow. The fourth thing that always happens before real estate crashes is oversupply. This is particularly relevant for commercial real estate, but it can also affect residential. When developers see prices rising and demand strong, they start building. They start building a lot. They assume demand will continue. They assume they can sell or lease whatever they build. But they all do this at the same time. They all see the same signals. They all respond the same way. And the result is massive oversupply, too much inventory, too many properties chasing too few buyers or tenants. Construction has long lead times. From the time a developer decides to build to the time the property is completed and ready for occupancy is typically 2 to 3 years or more. So supply responds to demand with a significant lag. When demand is strong today, supply that comes to market 2 or 3 years from now reflects that past demand. But if demand weakens in the meantime, all that supply hits the market when demand is falling. Vacancies spike, rents fall, prices crash. This supply-demand imbalance is what caused the office building crash in the early 1990s. Developers built massive amounts of office space in the 80s. Then the economy slowed, corporate America started downsizing, demand for office space fell, but all the supply that had been started in the late 80s was completing in the early 90s. Vacancy rates spiked to 20, 25, even 30% in some markets. Rents collapsed, property values crashed, many developers and building owners went bankrupt. The same thing happened with condos in the mid-2000s. Developers saw strong demand and rising prices in 2003 and 2004, They started building condos aggressively. Miami, Las Vegas, Phoenix, California. Thousands and thousands of condo units. But by the time these units were completing in 2007 and 2008, demand had evaporated. The market had turned. Nobody wanted to buy condos anymore. Developers were stuck with massive inventory they couldn't sell. Prices crashed 50, 60, 70% in some markets. Right now, I'm watching supply very carefully in multifamily. From 2020 to 2023, developers built apartment buildings aggressively. They saw strong rent growth during COVID. They saw people moving. They saw demand. So they built, and now all of that supply is hitting the market. We're seeing record levels of apartment completions in 2024 and 2025. Markets like Austin, Phoenix, Charlotte, Nashville are being flooded with new supply. Vacancy rates are rising. Rents are falling. This is the oversupply warning sign flashing red. In office, we have a different kind of oversupply. Not new construction, but functional oversupply. Because of work from home, companies need less office space. They're not renewing leases. They're downsizing. So even though there's not a lot of new office construction, the existing inventory is effectively oversupplied because demand has permanently declined. Vacancy rates in offices are at historic highs. Class B and C buildings are at 40, 50% vacancy. That's catastrophic. That's a crash that's already happening. The fifth thing that always happens before real estate crashes is denial and complacency. This is the psychological component. When all the other warning signs are present, when credit growth is excessive, when speculation is rampant, when affordability is terrible, when oversupply is building, you would think people would recognize the danger. You would think they would get cautious, but they don't. They're in denial. They convince themselves that this time is different, that there are reasons why prices will keep rising forever, that a crash can't happen. Before the 2008 crash, I heard every excuse. Housing prices never decline nationally. People always need a place to live. We're not making any more land. Interest rates will stay low forever. Subprime is contained. The problems are limited to a few markets. It's a soft landing. Every single one of these statements was wrong. Housing prices crashed nationally. Demand collapsed. Interest rates didn't matter because people lost their jobs and couldn't afford any mortgage payment. Subprime wasn't contained. It infected the entire financial system. And it wasn't a soft landing. It was the worst financial crisis since the Great Depression. But in 2006 and 2007, when I was warning about the housing bubble, when I was shorting mortgage-backed securities, people thought I was crazy. They were in denial. They couldn't imagine that housing prices could fall. They couldn't imagine that the party could end. And that denial is what allowed the bubble to grow so large. That denial is what made the crash so devastating when it finally came. Right now, I'm seeing denial and complacency in commercial real estate, particularly in office. People keep saying that workers will come back to the office, that work from home is temporary, that demand will recover. But it's been 3 years since COVID ended. And office occupancy is still only 60 to 70% of pre-COVID levels. This isn't temporary. This is permanent. The world has changed. But many office building owners are in denial. They're not accepting reality. They're not adjusting rents. They're not acknowledging that their properties are worth dramatically less than they paid for them. This denial is going to make the crash worse. I'm also seeing complacency in residential. Many homeowners think their home values are safe because they have low mortgage rates. They think they can just hold and wait for prices to recover if there's a downturn. But they're not thinking about what happens if they lose their job. What happens if they need to move for work? What happens if they get divorced or have a medical emergency? Life happens. And when life happens and you need to sell and prices are down 20 or 30%, that low mortgage rate doesn't help you. You're still taking a massive loss. The sixth thing that always happens before real estate crashes is the participation of unsophisticated investors. When real estate is in a bubble, when speculation is rampant, you start seeing people who have no business investing in real estate getting involved. Your dentist is buying rental properties. Your accountant is flipping houses. Your Uber driver is talking about investment properties. When everyone is a real estate investor, when it becomes a cultural phenomenon, that's a sign that the bubble is reaching its peak. That's a sign that the crash is imminent. Sophisticated investors tend to enter markets early. They do their research. They buy when prices are reasonable and fundamentals are strong. They have long-term time horizons. They can weather downturns. Unsophisticated investors tend to enter markets late. They buy because everyone else is buying. They buy because prices are going up. They buy because they don't want to miss out. They're driven by FOMO, fear of missing out. And they buy at exactly the wrong time, at the peak, right before the crash. Before the 2008 crash, real estate investing became a cultural obsession. There were TV shows about flipping houses, books about getting rich in real estate, seminars promising to teach you how to make millions with no money down. Everyone wanted to be a real estate investor. And all of these late entrants, all of these unsophisticated investors bought at peak prices with maximum leverage. And they got destroyed when the market crashed. Right now, I'm watching to see if unsophisticated investors are piling into real estate in residential. I'm actually seeing the opposite. Home buying activity is very low. People are sitting on the sidelines because of affordability concerns. So I'm not seeing the same kind of speculation and FOMO that I saw in 2005 and 2006. That's actually a positive sign for residential. But in certain commercial real estate sectors, particularly multifamily, I did see unsophisticated investors piling in during 2020 and 2021. Retail investors were buying into syndications and private real estate funds. They were chasing yields, they were chasing returns, they were buying into deals at 3 and 4% cap rates thinking they were getting great opportunities. Many of those investments are now underwater. Many of those sponsors are struggling to make mortgage payments. That late cycle buying is now unwinding. That crash is happening. The seventh thing that always happens before real estate crashes is a trigger. This is the event or series of events that tips the market from boom to bust. That changes sentiment from optimism to pessimism. That causes buyers to pull back and prices to start falling. The trigger can be different in each cycle. Sometimes it's a recession. Sometimes it's rising interest rates. Sometimes it's a specific default or bankruptcy that causes contagion. Sometimes it's regulatory changes. But there's always a trigger. In the 2008 crash, the trigger was rising default rates on subprime mortgages. In 2006, these defaults started to spike. Lenders started to fail. Bear Stearns hedge funds that invested in mortgage-backed securities blew up. Suddenly, people realized there was a problem. Sentiment shifted. Buyers pulled back, and the crash accelerated. In the early 1990s crash, the trigger was the savings and loan crisis. Hundreds of S&Ls failed because they had made bad real estate loans. The government had to step in and bail them out. The Resolution Trust Corporation was created to liquidate all the bad assets. This flooded the market with distressed properties. Prices crashed. Right now, I'm watching for potential triggers. One possibility is a wave of commercial real estate defaults. Many office building loans are maturing over the next 2 to 3 years. These properties are worth less than their mortgage balances. The owners can't refinance. They're going to default and hand the keys back to the lenders. If this happens in large numbers, if we see major defaults and lender failures, that could be the trigger that causes broader contagion. Another possibility is a recession. If the economy slows significantly, if unemployment rises, people will lose their jobs. They won't be able to afford their mortgage payments or rent. Defaults will rise. Demand will fall. Prices will decline. A recession is often the trigger that pops real estate bubbles. A third possibility is a significant rise in interest rates. If the Fed has to raise rates aggressively to fight inflation, mortgage rates could go to 8 or 9%. At those rates, almost nobody can afford to buy. Demand collapses. Prices have to fall to restore affordability. Rising rates have historically been a common trigger for real estate crashes. So those are the 7 things that always happen before real estate crashes. Excessive credit growth, speculative excess, affordability, deterioration, oversupply, denial and complacency, participation of unsophisticated investors, and a trigger that tips the market from boom to bust. When you see these warning signs accumulating, when you see multiple indicators flashing red, you know a crash is coming. It might not happen immediately, but it's coming, and you need to prepare. So what should you do with this information? How should you position yourself? It depends on your situation. If you own real estate, you need to assess whether you're in a vulnerable market or property type. If you own office buildings, you're in trouble. You should be thinking about how to get out, how to sell, or how to restructure your debt. If you own apartments in oversupplied markets like Austin or Phoenix, you should be conservative. Don't assume rents will recover quickly. Plan for vacancies, build cash reserves, If you own a primary residence, you're probably fine as long as you can afford the mortgage payment and you're not planning to move soon. Primary residences are for living in, not for speculating with. If you bought a home you can afford and you plan to live there long-term, short-term price fluctuations don't matter. But if you stretch to buy a home you can barely afford, or if you need to sell in the next few years, you should be concerned. You might want to consider selling now while prices are still elevated rather than waiting and hoping they recover. If you're thinking about buying real estate, you should be patient. You should wait for better opportunities. Prices are elevated in many markets. Affordability is terrible. Why rush to buy at peak prices? Wait for the market to correct. Wait for better entry points. Have your capital ready. Have your financing arranged. And when prices fall 20 or 30%, when everyone else is scared and selling, that's when you buy. That's when the great opportunities appear. If you're an investor, if you have capital, a real estate crash creates enormous opportunities. In 2009, 2010, and 2011, after the crash, I bought residential mortgages at massive discounts. I bought commercial real estate at 40 or 50 cents on the dollar. I made enormous returns as the market recovered. But you can only take advantage of these opportunities if you have capital, if you're liquid, if you're not over-leveraged yourself. So if you think a crash is coming, raise cash, build liquidity, reduce your own leverage, position yourself to be a buyer when everyone else is a forced seller. You can also profit from real estate crashes by shorting. This is more sophisticated and not appropriate for most investors. But if you're experienced, you can short real estate investment trusts. You can buy put options on home builders. You can short commercial mortgage-backed securities. I made billions of dollars shorting the housing market before the 2008 crash. But this is very risky. The timing is hard to get right. The market can stay irrational longer than you can stay solvent. So only sophisticated investors should consider shorting. For most people, the best strategy is simple. Be conservative, reduce risk, build liquidity, and wait for opportunities. Don't try to time the exact top or bottom. Don't try to be a hero. Just be prudent, protect what you have, and be ready to act when opportunities present themselves. Let me be clear about what I'm predicting. I'm not predicting a nationwide housing crash like 2008. The residential market today is very different from 2006. Lending standards are much tighter. Homeowners have significant equity. Most mortgages are fixed rate at low rates. There's not the same level of leverage and speculation. So while I think some residential markets might see price declines of 10 to 20%, particularly expensive markets where affordability is worst, I don't think we're going to see the 50 to 60% declines we saw in markets like Phoenix and Las Vegas in 2008. But commercial real estate is a different story. Office buildings are in a catastrophic downturn that's already happening. Retail is struggling. Some multifamily markets are oversupplied and seeing rent declines. I think we're going to see significant distress in commercial real estate over the next 2 to 3 years. Property values declining 30 to 50% in some sectors, defaults rising, lenders taking losses, some regional banks failing. This is going to be painful for people who own these assets or who have exposure through REITs or private funds. The opportunity for investors is going to come from this distress. When properties are foreclosed, when lenders are desperate to get bad loans off their books, when sellers are forced to liquidate at any price, that's when you buy. That's when you make generational returns. But you can only take advantage if you're prepared, if you understand what's happening, if you recognize the warning signs, if you have capital ready. That's why I'm telling you about these 7 things that always happen before real estate crashes. So you can recognize them, so you can prepare, so you can protect yourself from losses or position yourself for gains. Real estate crashes are predictable. The warning signs are clear. The patterns repeat over and over. You just need to know what to look for. And now you do. Watch for excessive credit growth. Watch for speculation. Watch for affordability deterioration. Watch for oversupply. Watch for denial and complacency. Watch for unsophisticated investors piling in. And watch for triggers. When you see these warning signs accumulating, you know it's coming and you can act accordingly. That's what always happens before real estate crashes. Now go protect yourself and prepare for opportunities.